Hello, everyone, and welcome back to the all-new Blueprint strategy course, and welcome back to Module 4, Market Timing. Once again, in this third part of this module, we're going to continue where we left off. There are two more zone qualifiers that we need to cover, which is arrival as well as profit margin, and we need to speak about trade management. Now, the last time we had a session, part 2 of the market timing module, we talked about crude oil, and we've done the analysis for crude oil. And this is a trade that now got triggered. So maybe this is a perfect example to now jump ahead into trade management. And then after that, I'm going to give you a cheat sheet with all the zone qualifiers, including the two that we haven't talked about, since they're also zone qualifiers that are less important. So there's going to be less priority on profit margin as well as arrival as compared to the other zone qualifiers that we've looked at so far. So let's recapture what we talked about when we looked at crude oil last time. So crude oil, we said, was positioned low, right? So price last week was here somewhere, and then we had a demand right here and a supply right there. So we were low and very low. We also concluded that there may be, well, there's definitely a sideways trend, but there may be an anticipatory uptrend with an inverted head and shoulders pattern. So these white lines we drew, and we said maybe here is going to be that new lower, that new higher low that's going to take place. However, it's not really a higher low. It's now, I would call it the same low or even a lower low. So it's not really a head and shoulders anymore, right? This cannot be a head and shoulders. So it can also not be an anticipatory uptrend. So it's just a sideways trend. And depending on the trend that we are determining here, this trade idea to be on or under, the trade management rules will change accordingly. So I'll show you that. But so now this turns out to be a sideways trend, not an anticipatory uptrend. And in terms of the true seasonals, we said, well, the true seasonals now maybe a little bit sideways. And then from the 20th all the way to into July, we should have a very bullish seasonality, and that's all starting potentially slightly early here. So the seasonality is very favorable, we said. And then we also talked about the valuation against gold, and we said if we're undervalued here on a 240 minute, then we can look to buy, and we were just about undervalued here, right? So very close, so perfect setup. And of course, we also had looked at our commercials. Let's just recap that to make it a full recap. So this should have been on the weekly. And the commercials were buying as well right there, right? So the commercials were buying. The retailers weren't selling, so it could have been a better COT setup, but the commercials were buying at least. We were undervalued. We were in low. It's just a sideways trend. The seasonals are bullish, so not a whole lot that speaks against that trade. And so what happened is price came into our 240-minute demand area that met all of our rules, right? All of our rules. We had departure. Yes, it was a strong leg out. Base, yes. Freshness, yes. But it wasn't original, and it wasn't a flip. Okay. and it did not have a level on top of level. However, it's covered by the big brother. And then what we did is we placed our entry on the proximal, and that's always something that we will do. Our entry, now the green line is on the proximal. Our stop loss, we use a 33% rule for the stop loss. And here it's a pretty good example on why we're doing that, right? Why we're using a 33% rule on our stop loss. Because you can see that price went into the distal, and it broke the distal, and it faked out a little bit, and then it reversed. So in terms of the concept of unfilled orders, of course, we don't know where the unfilled orders are, right? They could be anywhere within that area. They could all be sitting up there. They could all be sitting down here. Or in this case, they're all sitting around the distal right at that support area. So at the low of the demand. So we never quite know where is price going to turn. Is it going to turn from here? Is it going to turn from there? Or sometimes price even overshoots the levels a little bit before it then turns. So in this case, it overshot a little bit, and the 33% rule saved our behinds and allowed us to stay in this trade. So the stop loss, very important, needs to be 33%. So this right here from distal to stop loss is 33%, the size of the zone from proximal to distal. So you can see that if I'm now changing the proximal higher, the distal, the stop loss also moves lower because it's automatically calculating 33% from proximal to distal. Now that's our 33% rule. And you can see our 33% rule, we just need as additional wiggle room because we don't really know where these unfilled orders are. And sometimes price just tends to overshoot our areas, which then, just to be safe, we add an additional 33%, which is nothing scientific. It's just based on evidence and historical trade logs that if we have a stop loss that's too tight in the beginning of trading, we noticed that, oftentimes we would get stopped out without, and then price would turn without us. So we needed more space. And so it just turned out that a 33% based on mathematical backtests tends to be the perfect size, but even that sometimes is not quite enough. But most of the time this will be enough. This will be just plenty. So we've got a 33% stop loss rule that if you just turn on the minus 33 on your Fibonacci tool, then this will cover the stop loss if your 0 is on the proximal, if your 100 is on the proximal and your 0 is on the distal, right? That would mean that your minus 33 would also always be either below for demand or above for supply. And now the question, of course, is, well, this trade now would have been triggered here. We're in this trade. We took heat, but we didn't get stopped out. And now price is in the profit. Now, the question is, well, how do we manage that trade? How do we take profits? What do we do with our stop loss? So what I call trade management, what I always say is know when to hold them and know when to fold them. Now, as you gain experience in the financial markets, as you look at the overall context of price versus fundamentals versus seasonality, you may get a better understanding of, okay, how long can I potentially hold a specific trade for? Where is the opposing supply? Where do I see the risk of holding higher than the potential to make more reward, right? Because as price is climbing, it becomes a constant rolling calculation of how much risk do I have in terms of now price going against me versus what's the upside potential. So the higher price goes, the more corrective risk to the downside I have, the more money I have running as running profit on the table. So the more I want to secure potential in terms of potential monetary amounts of profit, and because the less the upside potential becomes, right? However, the lower price doesn't make sense for me to take profit because my upside potential is huge. So it becomes a running calculation in your head in terms of, okay, what are the risk factors? What's the corrective risk? How much monetary running profit do I have on the table versus how much upside potential is there? So know when to hold them, know when to fold them becomes a constant battle. And, you know, I always say bulls and bears get fed, but pigs get slaughtered. So we can only do well if we also take profits, right? We're not investors here. We don't want to get married to our trades. We don't want to hold on forever. We want to take profits and we want to move on and move on to the next trade. That's easier said than done. So what I'm going to do in the beginning, as you may not have a lot of trade experience yet, is I'm going to give you a simple set of rules that's going to allow you to follow an objective trade management approach. Okay, so the focus here is, of course, on risk to reward. So all the numbers that you see here, 1 to 2s, 1 to 1s, 1 to 2s, 1 to 4s, that's always based on risk to reward. And I'll show you how to put that into practice as well by using the Fibonacci tool in TradeStation. So we've got these 4 different trend scenarios, and based on those trend scenarios, our rules are going to slightly change, because if we trade within a trend scenario, our target potential is a lot higher than if we trade in a counter trend or a sideways trend scenario. So we're going to have to differentiate between a trend trade and a counter trend trade. Okay, so let's start with trend, because trend is probably the easiest. Well, we can start with, let's actually start with a sideways trade, because crude oil is a sideways trend. So that's a sideways trade. And now there's going to be 2 parameters that we look at. So eventually we want to move our stop loss to break even, and we want to place a target. We want to take some money eventually. So when do we put our stop loss to break even? During a sideways trade, we put our stop loss to break even if price reaches a 1-to-1 in terms of risk to reward. Okay, so if price hits a 1-to-1 in terms of risk to reward, we move our stop loss up to break even, which means worst case scenario, price now goes against us on crude oil. It's a break even gain, right? We don't win, we don't lose, which is quite a comfortable position, because we're sitting golden. If we look at crude oil, now price has rallied, and it looks like if this is our risk, this is our overall risk here, and I'm just gonna make a new parallel here, then it looks like price just about reached a 1-to-1. So price traveled the amount or the size, the same size of risk that we had. So -1, that could have been a $100 trade, that could have been a $200 trade, that could have been a $1,000 trade, or just a 1% risk trade. And here we are at +1. So this means that my risk, that price has reached a risk to reward of 1 to 1. So what do we do if price reaches a 1 to 1 is we move our stop loss. So this is our stop loss, right? We move our stop loss to break even, which means we move our stop loss to our entry. Okay. If we do that and price now goes against us, we'll be stopped out right where we entered. So there's not going to be a loss. There's not going to be a profit. So in this case, since it's a sideways trend, we're going to move our stop loss to break even. This means technically move stop loss to entry price, right? Move stop loss to entry price. And now this is a way of trade management because I'm now in the profit. If I risk $1,000 here, I'm now $1,000 in the running profit. I don't want to lose $1,000 now on this trade because that would be a delta of $2,000 that I would leave on the table, right? Because I'm already $1,000 in the plus. So I'm not going to leave $2,000 on the table. This is just way too much because now the upside potential here, our target is only a 1 to 2, right? Because it's just a sideways trend. It's not an uptrend where I may have more target potential, more profit potential. It's just a sideways trend. So very conservative target of 1 to 2. If we hit a 1 to 2, we're going to be out of this trade. So now, where is the 1 to 2? Roughly here, +2. So right here is going to be my target. If price, and I can set that target, right? I can just set it, and then I don't have to watch where price is going. If price is going to go there, great, I'm going to take profit. If price is going to go down, great, it's a zero-sum game. And so that's my target. Because it's a sideways trend, my target is at 1 to 2, risk to reward. And I can, again, preset that. So that's also a way of trade management because I have a preset, predefined target. I know where to get out, and that's set already. And I know how much is on the table because at the moment as it stands, right, my risk, if I leave my stop loss down here, what I have running on the table outweighs at this time what I have running on the table. 1 second. At this moment of time, because price is up there, what's running, I have this amount of risk on the table, -2. However, my upside potential at this point is only +1. So know when to hold them, know when to fold them. what am I going to do about that? Well, what I'm going to do about that is I'm going to move my stop loss to break even, so that the worst case, due to trend management, what's going to happen is this is all that's running on the table now. I'm either, because I already have a +1 here pocketed in, I'm either going to do a -1 here, which then at the end turns out to be a break-even game, right? So if we're going to be honest about it, realistic about it, this is going to be a 0. If price goes down, it's going to be a 0 for us. And if price goes up, it's going to be a +2 for us, right? But in terms of the running, that's how you will perceive it, because the more price climbs, the less upside potential there is, but the more corrective risk, right? The more money you're potentially leaving on the table if price all of a sudden was to go against us. And that's where know when to hold them, know when to fold them comes into play. And these rules in the beginning need to be really objective. So perfect. And I can remove now these boxes. I can remove these boxes because what I'm going to show you is how to set up the Fibonacci to get those kinds of areas as well. So what I know is that my risk goes from 100 to -33. So in terms of percentages, my risk is 133%. So I have to add boxes the size of 133% to my zone, right? So if I'm going to put a 133 here, then let's just leave those as 0 for now. Then guess what? Guess what? This is not a 1-to-1, right? That blue line that we just put in, that's not a 1-to-1. But I put in 133. How come that's not a 1-to-1? Well, it's only 33% of the entire zone, right? So you're adding basically 33 on top of 1 to get to 133. So what I need to put is, I need to put 233, because I'm adding 133 to the 100. So 133 plus the 100, because this is my starting point, equals 233. So if I'm going to put a 233, this is now my 1-to-1. And don't worry, I'll also show you how to set this as default. So this is your 1-to-1, which is based on fib numbers 233%. Remember, your entry based on fib is 100%. Your distal based on fib is the 0%. And your SL fib is the -33%. So if your box is the size of -33 to 100, that's 133%. If I need 133% on top of the 100, I need to add 133%, which is then gets to 233%. So now to add another 1, I always need to add 133 to that number to get to another 1, right? So to get to a 1-to-2 risk to reward to my target, In terms of fib, that will be a 366%. So I'm going to double click on that. And I'm just going to put 366%. And here we go. That's where my, that's where my target is, 1 to 2. But let's say I want more. I want a 1 to 3 and a 1 to 4 as well. Well, a 1 to 3 would be 499, and a 1 to 4 would be 632. Am I correct? So now I have a 1 to 3 if price goes here, and a 1 to 4 if price goes there. And what I can do with that is I can just set that as default, press OK. And now whenever I'm going to put a fib, I get all of these lines all the time, right? Which is something that I don't want. I don't want to show all of these lines all the time. So what I'm going to do is I'm going to click on this again. I'm going to untick them. And now I'm going to set them as default again. Now, what that means is if I'm putting my lines, I just have my 100 and my 0 lines that I'm getting, which is perfect. But then if I want to add my stop loss or my targets, then I have the preset numbers here for my stop loss, for my 1 to 1, 1 to 2, 1 to 3, 1 to 4. And then I can just tick them or untick them for when I need them, right? I can just tick them and untick them for when I need them. So here, what do I need? I just need the minus 33. I need the 1 to 1, and I need the 1 to 2. Here we go. And now we've got all our lines in our chart. We're objectively managing that trade. It became a zero-sum game. And best case scenario, we make a 1 to 2. Worst case scenario, we don't win, we don't lose. Now that is the know when to hold them, know when to fold them for a sideways trend. Okay. So this is your cheat sheet here, basically. You can print this out and then you always know what to do, but it's very simple. What's exactly the same as a sideways trend is a counter trend. So if you go against the trend, which I don't recommend, and it's not even an anticipatory, it's just against the trend, then it's the same parameters. You put your stop loss to break even if price reaches a 1 to 1, so you're really aggressive here, and you only take a 1 to 2 as a target. This could even be optional as a 1 to 1. At times, if you just want to take a quick profit. So for me, most of the time, counter trend just isn't an option because the probabilities are stacked against me, and it comes even with very little reward in proportion to my risk. Now, the best case scenario, of course, is a trend and or an anticipatory trend idea. So a trend, if we trade with the trend, I'm only going to put my stop loss to break even if price reaches a 1 to 2, compared to a 1 to 1, right? What we just did. That is because I know that there's more upside potential. There's potentially a 1 to 4, and therefore I want to give price more breathing space and more time to develop and to continue into that uptrend. Now, what creates money when we're in a trade most of the time is time. The longer we are potentially in a trade, the more probability there is that price eventually makes that move that we're anticipating it to make, because we can't pinpoint it. Is price going to make the big move today? Is it going to make it tomorrow? Is it going to make it in 1 week? However, if we have time, right, the longer we stay in a trade, the more probability there is that price is going to go towards our target. So we need to give it time. And because we need to give it time for price to continue those trends or even create those trends for an anticipatory, we also want to give it a little bit of breathing space. Now, the target for a trend trade is just going to be a 1 to 4. And our parameter to put our stop loss to break even is going to be a 1 to 2. If we look at an anticipatory trade, our target is also 1 to 4 because similar to a trend trade, we're anticipating price to make a bigger move. However, we're already going to start protecting ourselves if price reaches a 1 to 1. That is because if we trade anticipatory, the current trend condition is still down or up, right? Or the current trend condition is still against the trade that we take. So it may be downtrending if we're buying, it may be uptrending if we're selling. And so since we're technically trading a counter trend trade, but with the idea that, hey, it's the end of the bend, we're going to put our stop loss to break even at a 1 to 1. But since it's not a counter trend trade, since we're anticipating a bigger move, anticipatory, we're going to look to take bigger profits. So 1 to 4. So you can see trend and anticipatory, they're very similar. We look to take bigger profits. The only thing that changes is that we only protect ourselves at a 1 to 2 for trend and 1 to 1 for anticipatory. And then counter and sideways are exactly the same in terms of break even and targets. Now, there's always an option to have a second target on the table. I don't recommend that. Or to not have a target, to just trail on the higher time frame or trail on the lower time frame, depending on whether you do an anticipatory, sideways, counter, or trend. So only if you do trend anticipatory, you're going to look to trail on the higher time frame. If you do a sideways trend, you're going to trail on the lower time frame. So what that would look like, and that's optional, and that's also something that you may want to do in the future, is, for example, now if you say, well, the true seasonals are going to be very bullish next week, right? If you're going to say, well, I want to stay in this trade for all of this time because I can see that the true seasonals are very bullish. I don't want to get out just yet. So I see more upside potential. I don't just want to take a 1 to 2. I see more upside potential. That's pretty advanced. What you're going to say then is, well, I'm going to look to stay in this trade. I'm not going to put a target here, right? I'm not going to put a target. I'm still going to move my stop loss to break even. But what I'm going to do now is that if now price, for example, on the lower time frame, let's say this candle, let's make this a bit bigger. Let's say here we have a nice bullish candle, and then, we create another bullish candle, and then price is maybe coming back down again. What you're going to do is, in terms of trade management, is you're going to move your stop loss. First, you had it at break even, but now you're going to move it below newly created demand. So this is your new stop loss. In this case, you're protecting a little bit of money, but you have the chance that if price now goes down here, right, and you're seeing, hey, seasonality is going to be bullish, I see more upside potential. Of course, with yin comes a yang. What's going to happen is, hey, you may stay in that trade now, right? And if price moves higher, if price really is going to move higher, then with that, you have the option and the possibility to potentially stay in this trade. And then, let's say price is again going down a bit, then it's moving higher. it's again creating new demand, what you're going to do is, hey, there's new demand. So I'm going to put my stop loss again up higher. So now you're starting to trail, right? That's a technical trail. You're starting to trail and you're moving your stop loss higher as new demand is being formed in the process. So then price may go down here, and then it may just go straight up higher, right? And then eventually you just want to take profit, right? But you can trail your way up until you're at an area where, you know, you see, okay, that's the upside potential, 1 to 4. I'm happy. I'm going to take that. And then you can trail your way up as price moves higher. And as price moves higher, it has to create new lower time frame demand, right, in the process. So you're always going to just move your stop loss higher. You're going to trail with newly formed demand. So that's a form of trade management. That's a technical trail. And a technical trail for demand is either on the lower time frame or the higher time frame. Right now I'm on the lower time frame because it's a sideways trend. So move stop loss below newly formed demand. And then a technical trail for supply is move stop loss above newly formed supply. And most of the time you will do that if you see an extremely bullish, both fundamental and technical scenario where you're really predicting a longer term move, a bigger move, then you would look to trail, because then you kind of have the perfect combination of, hey, probability of staying in this trade and always securing just a little bit more profit, for as long as we stay in that new trend condition. So I now want to give you the cheat sheet for your zone qualifiers, right? So we're going to look at freshness, at base duration, and at departure. They're the most important rules. And then there's going to be profit margin and arrival as well that we may want to look at. Okay, So I'm going to give you the rules on that, starting with profit margin. So profit margin is asking, and it goes hand in glove with departure. Hence, it's not so important, because if you have a good departure, most of the time you have a good profit margin too. It goes hand in glove. So we're asking, how far has price traveled away from the zone as it had created the zone? Okay, so we're looking at the leg out and how far price had traveled away from the zone from a risk to reward perspective. And so a 1 to 3 is acceptable, a 1 to 5 is great, a 1 to 2 is not acceptable here in this example. However, sometimes we also will take that. If the zone, for example, is extremely large, then, you know, if the move, for example, here is great, but also this comes with a big zone, then of course, if just these wicks are bigger, right, and the bodies are bigger, then it makes the zone bigger, but the move is the same, right? So it still may be a powerful move. So it kind of depends here, but just for the beginning, you may want to argue that the less price has traveled away from the zone in terms of a risk to reward ratio, the less quality that zone comes with, okay? The less unfilled order that zone may come with. That's something that you can argue. So you would measure that on the preferred version, and the conservative rule is that price must travel a minimum of 1 to 3 away from the zone before price comes back, regardless of trend. So for our examples, now, because we have beautiful examples here that we can build on, now additional rules that are less important. And I hope I'm driving this home why they are less important. So here it comes rule 7, profit margin, because profit margin, it may sound like, hey, that's an important rule, but as we're looking at the explosive leg out, this should already cater for profit margin. But in this case, this was our original zone from proximal to distal. And then how far has price traveled away from the zone before it came back? Okay, so in this case, price traveled all the way to here. That was the high. Before then, price came back into our zone. So in terms of risk to reward, and I want you to just eyeball that. I don't want you to use the fib or anything like that. Just eyeball it. If I go from proximal to distal, then do I have 3 times as much space, right? So 1, 2, 3, 4, 4.5 roughly. So bigger than 3, right? So in this case, we met the rules here perfectly for also profit margin. But even if it didn't, it may have still been a good trade. So in this case, it's perfect, right? We're trying to tick as many boxes as possible. Again, the more boxes you can tick, the higher the quality of your zone, the tougher it is to find one. But hey, the higher the quality. So lastly, we're going to look at arrival. And arrival is something that we just look at counter trend, or we could also look at it during sideways trends. And what we're trying to do is we're trying to make sure that there's not a whole lot of opposing supply if we're trading demand, or opposing demand if we're trading supply, that's being created as price reaches our zone. So on arrival, here we would have good arrivals because I can see this is my supply, right? That was created, that price comes back. And as price comes back, it's just green candles. There's no supply that's created here somewhere, right? So what I don't want is supply to be created here, and then I'm selling this, and then price just goes against me because it's reacting to demand, so opposing demand. So what I want is there not to be any opposing levels that had been created in the way. So whether that's a steep move, whether that's like kind of a stair-stepping move, that's also fine, as long as there are not any opposing supply or demand zones that are created. And so a clean arrival is important for ensuring profit margin of 1 to 2, and that's important for sideways or counter trend trades. When we're trading with the trend, it really doesn't matter. So if we trade with the trend, we don't look at that. But if we trade sideways or counter trend, we're going to look at that. So here you see an example, very clean arrival into a demand zone, just one large candle, which means, hey, you know, price has enough space to kind of rally back into opposing supply. So what that would look like in this scenario as price came back, this is pretty good because I don't really see a whole lot of supply apart from here, right? So maybe here is the first supply that I see. And then I have quite a lot of supply. I have supply here and I have supply here. So it's a sideways trend. In this case, oops, you can see that I'm not paying a lot of attention to that specific rule, because if I was paying attention to that rule, then where is it? Here. Decisive explosive candles, no opposing zones created. And a clean arrival is important for ensuring profit margin of at least bigger than 1 to 2, right? So there needs to be at least profit margin of bigger than 1 to 2. Now with the zone that we had, because there is already opposing supply right there, let's call it, and my 1 to 2 is up here, if I were to look at that rule and if I was to isolate it, that arrival rule is not really met, right? It's not really met. Because I do not have a 1 to 2 clear headway, right? It's not clear. Price has to fight through supply in the process. However, there are here under additional rules, they're less important. They're less important. So looking at the context of everything that we've done in terms of the departure, the base, the freshness, we looked at the fundamentals and the higher time frame technicals, they overrule these rules, right? If they're all checked, then looking at one rule down the line at the very end, looking at that isolated, we're not going to say no to a trade just because one of the rules may not fall in line with that. If it fell in line, the better, right? But we're always going to have to approach this from a higher time frame context, fundamentals first, then lower time frame. So this is what we're going to do. So in terms of your importance, right? So higher time frame, technical plus fundamentals. That's your very first, right? So if that's checked, and on two, your lower time frames are within the right context of 1, if that's checked, then you go into zone qualifiers 1 to 6, and here you get most of them checked. Then whether or not you get here on 4 on additional zone qualifiers, whether or not you're going to get checks on 4 really doesn't matter, because it's really down the line, right? We're checking to understand, to get some context. Hey, maybe, you know, where's opposing supply? That's why we're checking that. We're checking the arrival because we're checking, hey, where's opposing supply? So the advanced understanding that you should get out of this, because there is a reason behind that rule, right? So because I know what you're saying. You're saying, Jan, why are you giving me rules that you don't even use yourself, right? And that we don't need to adhere to anyways. Well, I want to give you rules so you start training your eyes to look at certain things. Because the more advanced you become, you want to look at certain things that are more gray. So, for example, when you're trailing or when you're taking advanced profits, you may not always just take a 1 to 2. Here, for example, you may choose to take a profit a little bit early, right? Or you may just look to stay into this for the long haul, because right now, as it stands, the 1 to 2 objective target would just be within kind of supply areas, right? So maybe it doesn't make a lot of sense. So your advanced understanding and how I want you to train your eyes is to look at the rival, because then as you look at the rival, you're going to say, hey, where's opposing supply? And as you look at opposing supply, you identify potential technical risk areas from where price may turn. And so if you're observing this now and you're putting this in, and at least you're knowing this, and then you're seeing, hey, I had my target here, right? And then what happened is price came into here and then it turned all the way against me. Then you're like, hey, my technical target of 1 to 2 price didn't quite reach that. But why didn't price reach that? Well, because maybe price was reacting to opposing supply. So while a rule may not be important in the beginning for you to be allowed to take a trade, right? So we look at rules for you to be allowed to take a trade. They may still be important for you to train your eyes to look at certain things that as you become more advanced, you want to start looking at those things in a more gray manner. You want to follow price. You want to look at opposing supply and demand zones. You don't want to be so strict and black and white. You want to become more gray. And the only way you can become more gray is if you train your eyes to look at certain things. Now, these things need to be objective in the beginning and scientific. Otherwise, how are you going to train your eyes? But later on, this will become second nature for you. And then rather than having those 8 rules, you're just going to look at one zone and all of a sudden, you know, hey, this is a zone I'm going to buy, right? This is going to be so internalized that you don't even need to go and check all these boxes. While in the beginning, this is how you literally train your eyes. And then later on, it's just an internalized process. You're just going to look at it once, 2 minutes, and then that's done. So with that, I guess we can end the chapter of zone qualifiers and know when to hold them, know when to hold them. You've got your complete checklist. You've got your importance matrix. You know, you've got a trade management cheat sheet. You've got your fibs figured out. We know where to put the entries. We know where to put the stop losses. We know where to put the targets. We know when to put the stop losses to break even. We can go ahead and take trades, right? You can go ahead and do full analysis on daily income, on weekly income, on any market, follow the process, and come back with a trade idea. So for the next time, we may just do practical applications on putting everything together. And then after that, we're going to move into the optimizer. All right. But before we move into the optimizer, I do want to do quite a lot of practical applications, just going through that with you together, analyzing gold, analyzing silver based on all of our rules. Then also continue to maintain our blueprint cheat sheet and maybe add on to that. And so we still have quite some work to do in terms of just practical applications now, right? Just putting the theories into practice. That's the nice part. That's the exciting part, because now we're trying to find trades. And I'm trying to give you pointers in terms of additional things you may want to put on top put down to your blueprint cheat sheets that may not be covered in these general rules that cover all markets. for some specific markets, like gold, for example. You want to look at the net commercials as well sometimes, right? And there may be additional rules. Or for equity indices, you may want to look at the .D charts, and why is that? So I'm going to try and each week go through a category of assets. So next week, maybe we'll do equity indices. The week after, maybe do energies. The week after, maybe we'll do precious metals. The week after, maybe we'll do Forex. The week after, maybe we'll do stocks. And then once we have some categories that we just looked at overall quickly for 1 to 2 hours and did some practical applications, and I give you some pointers, then we can move to the optimizer. All right. So thanks for watching. Happy and safe trading, and ciao.